think is also an important consideration as we'll try and display in this session. You have to understand the jagged edges, right? AI in finance is not a solved problem, right? It's not a solved problem. When people say AI Excel is a solved problem, I'm like, you are wrong, right? You are very wrong. We have made insane improvements in the last 6 months, but there are still many jagged edges that are very problematic for the investing process. So what we're trying to do here is shine a light on those jagged processes, think about workarounds, but also be very objective about where these tools are. Thank you everyone for joining today in this third installment of this random webinar series on augmenting investment process with AI. Today we will talk about Microsoft Excel and what can and in my experimentation can't be done with AI, which I think is, in a way, it's as an important piece to understand the true limitations of these tools. So I'll show you what I've learned in 3 weeks. So hopefully you don't have to spend the same amount of time that I did going down all of these random rabbit holes. To preempt a couple commonly asked questions, yes, the recording will be sent if you're registered on Zoom. It'll also be posted on YouTube, which we'll release on our Twitter at FundamentEdge. No, we will not share any of the skills.md files. We're beginning to do that selectively with clients and sort of firm clients and students of our programs, but we won't be doing that in the open webinars. Without further ado, I will go ahead and share my screen and we'll jump right into it. Disclaimer. Nothing we discuss will be investment advice. If it was, you probably shouldn't listen to me. Even in a good year, I was right 52% of the time. In the bad year, I was catastrophically wrong. So don't listen to some random person on the internet. Always do your own due diligence. Reminder of my background. I was an investor. I was a fundamental analyst and portfolio manager for 13 years. I randomly backed my way into seats where I sort of had a front row seat to the combination of fundamental and quantitative investing, really the outside of my career in 2008 at a Tiger Cub. But I found it deeply intellectually fascinating to think about the combination of fundamental and quantitative investing. And so I bring many of those priors to this work, sort of the deep engineering mindset of the fundamental investors workflow and sort of a quantitative lens of taking what is often a very intuitive or tacit approach to investing and systematizing that. We do that in our Analyst Academy, where for 60 hours we break down fundamental investment processes. So that's a good starting point to think about augmentation. Sort of a combination of the priors from Quantamental with just an experimentation journey. For the last 2 or 3 years, we started a webinar series on AI vendors in fall of 2024. I just looked, actually. I ignored a direct message from Gabe from Rogo for like 18 months before I finally got back to him, and then they just raised it a $2 billion valuation yesterday. So congratulations, Team Rogo. Really, my learning approach is taking the priors of the lived experience as an investor. And a lot of conversations with people who are in the trenches building, finding the right people to follow on YouTube and Twitter has great leverage. Most of what you'll see is just simple parallel experimentation. I think the best way to learn AI really is just start using it and A/B testing. Do it the old way, do it the new way. And you'll be surprised. You'll be surprised and often frustrated. Sometimes things that work one day won't work the other. Due to the non-deterministic stochastic nature of these tools, which also are often throttled, et cetera, throttled and nerfed. But I'd say that's probably the most helpful process. So use me as a guinea pig. I know you all are very, very busy. And then we ran an AI for investment research cohort starting in September, where we had 150 analysts and PMs, really learning a lot of this together. We're starting to do more client engagements to help funds actually adopt agentic investment processes. And part of my experimentation has been building an AI native mock portfolio, pretending I'm back in the seat, managing capital again, I'm at a little bit of a sticking point on that. So I'll update you on that. Excel is actually a key sticking point on the ability to do that as a side hustle. And then, of course, I always sort of half jokingly point to Cunningham's law. The best way to get the right answer is to post the wrong answer on the internet. So I get a lot of people telling me I'm an idiot on X, and sometimes I am. But if they point out things that I can learn from, thank you, Cunningham's law. So I don't know everything, but I know one thing. I know that we all have the same 3,000 hours in a year. Roughly 60 hours a week is sort of buy side-ish standard. The 7 to 7, Monday through Thursday, cut out a little bit early Friday, and then a Sunday afternoon, give or take 5 or 10 hours, sort of standard for an investor. And so part of the approach in thinking about AI augmentation is starting with that known constraint of hours and start to think about, the exercise of will AI generate alpha starts with that known constraint. So to me, I sort of think about coverage capacity. This is more of a multi-manager mindset for sure. But a typical multi-manager mindset is there's sort of a cap on the number of companies an analyst or a PM can cover. Generally, that you don't see that much above 50, simply because the general consensus on good coverage, good institutional grade coverage is we have our own models, we update our own models, we meet with management regularly. There's a lot of motion on earnings season. There's a lot of just desktop research, reading sell-side research, reading Ks, reading 8Ks, and primary research, talking to the management team, surveys, et cetera. So at a very broad strokes, 60 hours per year per name. That's just the staying in the flow, I guess, is part of building a model as well, too. So it's sort of very rough explanation of the coverage capacity, the workflow of an institutional investor. So before we start thinking about scaling this, we have to think about, how do we scale these efficiencies in a rigorous way? What part of these areas can we actually scale? And so if you sort of take it on faith that these tools are ready or near ready for scaling fundamental investment process, let's dig in and sort of experiment and go through the individual pieces. There are certain things like meeting management where, there's sort of no clear line of sight into scaling. But one of the big areas of scaling is modeling, right? If I can click a button and get a financial model that is no different from my existing financial models, if I can click a button and upgrade a model in a comprehensive, accurate way, that starts to do one of two things. One, that starts to really scale the names I can have under coverage in that same 3,000 hours. So I could cover more names. As a healthcare investor, I always went back and forth on covering European names, just the scaling of what I had to do, the blocking and tackling in the US generally meant that I ignored European names. I could pick up Europe and add that sort of orthogonalized alpha stream to my book. Or I could go deeper on existing names. I could take these hours saved, and I could all of a sudden be doing 30 hours per name on primary research, or 12 hours per name meeting management, right? So I can redeploy those hours in workflows that deepen my comprehension. So I'd say, as in sort of the evolution of AI moving into Excel is a big deal. The question is, what does it mean, right? And so let's first talk about, from the investor lens, what a model does, right? Because the design structure, purpose of a hedge fund or long only model is going to be very different than a sell side model, and certainly different from an investment banking model. The buy side equities model has a few characteristics. It's built to be maintained for years, right? You're updated every quarter under time pressure. It's built as a communication tool, right? Analyst sends to PM, analyst sends out to the team. We're all looking at the model as a quantification of a thesis. It has to be flexible. You have to be able to run scenarios. The model is a thinking tool. It's not an answer unto itself. And so you have to be able to understand, hey, comp's up, comp's accelerating, decelerating by 100, 200 bips. What does that mean to EPS? What are the incrementals of the business? How does that flow through? So we're really optimizing for fast updates, easy auditing, analytical flexibility. I tell the story, the first model I built, my first hedge fund job, I had manual circs and VLOOKUPs and all this crazy stuff, and I got yelled at, just like, don't do that, right? The models are meant to be, simple. And some of the models you'll see on the buy side are like, you'd be shocked at how simple they are, and that's fine, right? Simple is great. They need to be clean, they need to be functional, they need to be flexible, they need to be intuitive. And the standard we recommend is a quarterly update shouldn't take more than 15 minutes. If you're building a model that takes more than an hour to update, you've misbuilt that model. There are shortcuts and data updates, data sections, et cetera, that I would argue you can get virtually any model updatable within 15 minutes. So they're built to enhance the deep understanding of the business, to track fundamentals over time, a baseline for risk reward, and to help you navigate earnings and news. Hey, an 8K drops, something happens. Let me pull my model and see what that means to earnings. Earnings cut 10%, stocks off 3%. Hey, guess what? I'm going to sell that. Earnings cut 3%, stock off 10%. It bounces back next year. Hey, guess what? That's a buyable opportunity, right? So it helps to frame and quantify what's going on in the market. So the buy side model is a thinking instrument. You can't one shot a correct buy side model, right? We're not here to press a button, get a DCF, get an answer, and the game is done, right? It's sort of a silly use case. Very few investors use DCF for point in time price target derivation anyways. They will use them to understand expectations as one tool to understand expectations. But what we're really focused here are on earnings models, and a lot of the value, the ultimate sort of make or break of the thesis is in the forecast, right? The model is a place to encode the analyst's best judgment about a business. So that's important when we think about engaging with LLMs, where OpenAI has hired all these investment bankers. There's a lot of in the LLM training corpus, investment banking highly influences the thinking about financial modeling, as Buffett highly influences the thinking about investment research. That's great if you're an investment banker. That's great if you're a Buffett lookalike. That's a little bit different if you're working at a high velocity multi-manager hedge fund, right? And so we have to take account for that when we think about creating the system. So we're not building banking transactional models here that support a deal. We're not building sell-side equity models here that support coverage and distribution and tend to hug consensus. We're trying to get to the right answer, right? And the use case of the model really is fivefold. It's helping you go deep, right? The mandate in the institutional buy side is know your business is cold, right? Know all the nuances. My first PM would ask me, I'd talk to him about a company. He's like, walk me through the P&L. I'm like, what do you mean by that? He's like, start at revenue and from memory, walk me from revenue down to earnings per share, down to free cash flow. And like, I completely failed on that the first 3 times. The trauma of that failure encoded that in my brain to understand that when we cover businesses, our job is to really understand the nuances, the quantitative and the qualitative nuances of the business. So the model is helpful to do that. In that sense, building the model, the act of building a model is an educational process, right? That's why for really 5 years at least, I built every model from scratch. It helps to enforce mathematical rigor in the investment process by translating qualitative insights into precise financial models. Hey, the CFO said things are a little squishy. What does that mean? Does that mean 100 bips or 300 bips? Hey, a competitor said they're taking share. I validated with 3 other data points. What does that mean to organic revenue growth, right? Quantifying those narratives down to numbers is a really important process of the analyst, and the financial model is the critical substrate to do that. Ultimately, to drive differentiation and variant perception, right? The market thinks key drivers going up. I think it's going down, right? Out of covering 150 names at any time, maybe I have 10 or 15 opportunities where I clearly see a variant perception. The market's right more than it's wrong, in my experience. But using the model systematically to identify those opportunities, to understand what catalysts are really investable catalysts. Where does the beat and raise happen? Where does the miss and lower happen? Where does something happen in the business that meaningfully changes the net present value of the free cash flow streams of that business? And so really pinpointing the specific events, whether it's a regulatory event, a Supreme Court event, a phase 2 biotech readout, et cetera, And then valuation is really a secondary principle at most hedge funds. So they don't start with, hey, this looks cheap on consensus. They start with, let me understand the business, build my forecasts. And then often, a 3-year forecast is no more complex than what's my 4-year out number and slap a multiple on that. And so the outputs of your modeling process build the baseline of your valuation work. Right. So this is like all really important stuff. Right. And when people say, well, why do you build a financial model at a hedge fund, Brett? Why don't you just use cap IQ numbers or FactSet numbers? I'm like, you're kind of missing the whole point of what the job is. This is the whole point of the job. And having the financial model as the workbench of the analysts, like I couldn't have done my job without a financial model. Like you'd be investing on vibes. And so that's how critical the financial model is. And that's why, I sort of take a different lens on this session as well too, versus many of the vendor demos you see is like, hey, press a button, it has a DCF. I'm like, okay, that looks impressive maybe to a neophyte, but from a practical perspective, there's really no usability of that model that's generated. Not to mention AI slop and hallucinations and a few other things that we'll get into. We'll get into today. So really, the model is the workbench of the entire institutional equity research process. It's I have the model up through the entire thesis development arc, from idea origination to triage to due diligence to actually building the model, going deep on the key drivers, because ultimately your thesis will hinge on 2 or 3 inputs into the financial model. So the mechanics of building the model are more commoditized in nature. The real value, the real differentiation comes from simple inputs into just a couple cells in a financial model. How does that help insight formation? How does it help expectations and valuation work, understanding positioning, what people are playing for, et cetera, thesis construction. So how does the model sort of your workbench for building the thesis? But also, at large hedge funds, most of your models are built, right? You have existing models. A lot of the action happens in the active position management space, right? This is why I think early stage chatbots haven't been that helpful for hedge funds. Like, help me summarize this 10K. It's like, well, bro, I've covered HCA for 10 years. I've read every 10K. I don't need a summarization. I don't need to get up to speed and have an LLM tell me how the business makes money. I know that, right? I need a tool to help me drive differentiation on 3 key drivers, to help me through the earnings process and the catalyst path and maintenance process and management touch points and understanding news and catalysts and events and understanding how the risk reward adapts over time. And so just one of many reasons why I think chatbots haven't really reached escape velocity in the hedge fund world, certainly by any means. And part of the reason why agents are so damn interesting, because you can start to wrap a lot of this around with agents. So we'll talk a little bit about that. But sort of an important point is that investing is a Bayesian exercise. You sort of develop a prior, and then you're updating that prior really daily, weekly, monthly. Financial modeling is not a one and done exercise. And so a big part of the financial modeling exercise is building something that is that Bayesian tool to update news flow, competitive announcements. It's a tool to know the business cold, and then it's a tool to monitor the business closely. And so, in that sense, like an AI slop model or even templates, I think templates haven't really always hit the mark on monitoring the business closely element. So what you see if you walk into any hedge fund desk is you'll see folders of models like this, right? Well, you'll see every company has a financial model with segments and consensus and risk reward and key drivers and the full 3-statement model. When I was a PM with a 9-person team, we had 300 financial models. I could click open any model at any time. It was updated. I could get a sense of what our view was, where we sat relative to the street. And that's a really helpful foundational footprint to start trying to build a portfolio that beats the market, because of 300 names, we're trying to have maybe 25 longs and 40, 50, 60 shorts. And you're not starting from scratch on every name. Now that's a very multi-name when I worked at a Tiger Cub, I'd cover 100 stocks, and I didn't have all 100 of my models updated. If a name wasn't interesting, it would go out of date. It would go out of, updating for 2 or 3, 4 quarters. So one thing we always try to highlight in our curriculum is, there's no right way to be an investor. This is a very heterogeneous process. I'll hear, very impressive investors with $500 million positions being like, Brett, I don't build out quarterly models. I'm like, okay, well, if that works for you, please don't. Please continue doing what works for you. So you'll hear anywhere from, I build all my models from scratch to, modeling is a waste of time. I just use Canalist. And I say, great, right? The modeling approach that supports your investment process is the right approach for you. Now, often there's a mentality, there's a philosophy at these firms in the Tiger Cub community. It was often, certainly when I was there, was a no template rule. The multis I've been at, no template rules, build everything from scratch. If you're a small under-resourced generalist, if you're building every model from scratch versus using Canalist, that's probably not a great idea. And so just framing that heterogeneity as we get into AI, I expect and would actually suggest that everyone sort of thinks about using AI in their own specific way, with a few high-level considerations and high-level principles, right? There are many perils to using AI, right? Defect and slop. And probably one of the most concerning ones is just comprehension degradation, right? If I have an analyst who is AI pilled and 18 months in, they've not really understood anything about the businesses, it's very hard to take that leap to becoming an alpha generating stock picker, right? So AI can do your thinking for you, but it can't do the understanding. It can't really facilitate the comprehension, right? So the promise is acceleration, the promise is rigor, but the promise is really insight, right? So one of the core principles is if you're not using AI tools to develop and deepen insight, you have to sort of reset and rethink how you're using the tools. I think it's also an important consideration, as we'll try and display in this session. You have to understand the jagged edges, right? Certainly AI in finance is not a solved problem, right? It's not a solved problem. When people say AI Excel is a solved problem, I'm like, you are wrong, right? You are very wrong. We have made insane improvements in the last 6 months, but there are still many jagged edges that are very problematic for the investing process. So what we're trying to do here is shine a light on those jagged processes, think about workarounds, but also be very objective about where these tools where these tools are. With a venture capital funded vendor who needs to sort of sell that things are great, sometimes you don't get the balanced expression of those jagged edges. We'll talk a little bit about tool selection. Retrieval capabilities is still, I don't think multi-document retrieval has gotten a lot better. Still not a solved issue. There's still an ongoing debate on MCP and CLI, et cetera. And then validation. And this is where I think there's been some interesting breakthroughs, certainly in my experimentation. So we'll walk through that as well too. So 4 governing principles of all AI deployment, in my opinion, are, above all, we have to optimize for rigor over speed. We play the most competitive game in the world. Markets punish mediocre research. There's all sorts of checkpoints on that. So it all says we have to demand rigor. We have to build a broader net for signal identification. The idea is sort of the mental idea is like you can have an alt data team in your pocket or investigative journalists in your pocket or a quant NLP forensic accountant in your pocket. Broader net, more signals. With a validation system, that can't be a bad thing. Just conceptually, that can't be a bad thing. We want to compress the mechanical parts of the job, as long as, with the important caveat, as long as that compression doesn't impact comprehension. If we can free up from the 3,000 hours, 600 hours to redeploy on high value tasks, that's a nice win case. And then a 2-tiered validation system is critical, sort of systematic AI verification, but then the artisanal human verification. So these are 4 principles that I believe. One prior in that I point people to is sort of the prior of visible alpha and the spreading of consensus. Yes, believe it or not, when I first started on the buy side, I had to go email 12 sell side analysts, collect all the models, spread those hand by hand, talk about mind-numbing work. Each took me 1 or 2 hours. Maybe I learned something the first 1 or 2. After the 15th spread, It was really annoying. So when Visible Alpha came out and a software system does that, and eliminates many hours of that grunt work, I would argue there's very little, if any, alpha signal in that. But that frees up, maybe that freed up 50 hours in a year for me as a junior analyst. So those are the sort of like low-hanging fruit acceleration of mechanical opportunities that I'm chasing down there. I think there's a long list of that. So when it comes to modeling, right? It depends a lot on where you're at, what firm you're at. But my lived experience, I think anywhere from 10 to 25% of my time was spent on the purely mechanical parts of the modeling. I'm not talking about doing due diligence to input data points. I'm talking about just entering the data and organizing, building the analytics and connecting and validate the numbers and updating for quarters and doing a resegmentation rebuild. And hey, this model's 4 quarters out of date, or hey, there's a large transaction. Will you model that into the core operating model? So even as experienced analysts, it's not crazy to think that I'm spending maybe 300, 400, 500 hours a year out of my time on the purely mechanical. Now, I didn't put a slide on this, but if any of you have been in a multi-manager at one firm and go to another firm, you will intimately know red pen theory, where you don't get to most often you don't get to take models with you. So rather than spending time on a garden leave with your family or partner or traveling, often you're starting to think through the process of rebuilding your models from scratch, which if you've had the same models for 10 years, all of a sudden they are locked in a system and you have to rebuild those. That is an incredibly painful experience, having gone through that, having gone through that myself. So if I could help the next garden leave PM not have to go through that, I will have paid it forward. So if you've been tuning into this seminar series, you know that one of my Turing tests for investing AI is if I can cover and ramp on the 157 names that I used to cover 5 years ago. Now I have some historical context, but the idea is, can I refresh? Can I do full ramps? My sort of test is like, do I feel like I could go and pitch a portfolio of these names to a director of research or a biz dev at a hedge fund? I'm not there yet. But a big part of that is, can I update the models that are 157 names, right? I don't know how many models I have, 80 or 90. They're 5 years out of date. And there's probably a few dozen fresh rebuilds. So just that modeling exercise alone, if I were to, spend 20 hours on each model, 157 names, I've already burned through 12 months of pure modeling. This is, sort of many reasons why PMs hire junior analysts. This is one of them. Just the simple bottlenecks that exist in this process. Now, in reality, what I've done at various times is I've sent much of this work to an India team to do the basic inputting of numbers, but still, that doesn't take it from 20 hours down to 2. That maybe takes it from 20 down to 8. And once I have those models up, creating tracking systems for those 157 names. So I was a healthcare investor, healthcare X therapeutics. So this is sort of a rough coverage area. If I can't, I'm not going to go just start building these models from scratch. I want to find a way where I can press a button, show an example of my model, and have this model architecture built for me. I was hopeful that maybe I'd get a little bit closer in this exercise than I did. So I'd say, unfortunately, we're not there yet, at least from my experience. And I'm going to walk you through in the remaining 80 slides why. So I think it's possible soon, hopefully, to take these 10 new analyst builds, new model builds, cut the time down by 90%, do the updates. This is probably where we are at today, closer to today. The resegmentations, we're not at today. The large transactions, I don't think we're at today. So I think with the emergence of new tools, it seems possible to reduce the intensity of the mechanical parts of the investment process. And I'm going to show you a few things to do. And then again, the access time can be redeployed to go deeper or expand coverage. There are some positive signals, right? Rogo, has, I think, made good strides in the investment banking process. One of the things that you can do in the Rogo system now is you can basically put a ticker, press a button, and you get a very nice, like, to me, institutional grade accretion dilution analysis. This gives me the structure, right? And then I just need to go do due diligence on what I think the synergy phase in will be, or what the core, Massimo EBITDA number will be. But it sort of takes a lot of the mechanical annoyance of building an accretion dilution analyses. When I had an India team, one of their mandates was any name under coverage that does an overnight acquisition or early morning acquisition, build out an accretion dilution analysis. So before the market opens, I can see what the deal looks like, and we can make a decision to buy, sell, or hold that stock. This was in the 2015s when healthcare M&A was going crazy, but that was a nice advantage of having an overseas modeling team. Well, I don't need to do that anymore. I can press a button and in Rogo. So an architecture like this saves times, reduces errors, and a time crunch frees me up to actually research those key inputs. Everything's triage in investing. And when I get the press release at 7 a.m. that there's a large acquisition, the market opens at 9:30 a.m. Whether I'm done with my analysis or not, I have a 2.5 hour window to get as much insight on that transaction as possible. So if I can accelerate those moments, that's really helpful. One thing I want to point out in the session too is that AIXL is not just for building models. I've found 5.4 and 5.5 in particular to be quite Excel fluent. Even simple things like uploading a model into a GPT now. Don't do this before you get a compliance approval. But I could say, help me think through the right way to approach a revenue build. So as an ideation partner, Excel is there today. AIXL is there today, right? It gave me some interesting ideas to go to Amazon and break down net service sales, the disclosure between online stores, physical stores, the product level disclosure, and then map that back into the net product and net service sales, which fit on the source of the P&L. So solving these little puzzles that aren't really that value additive, but can give me a way to think about revenue build. So much of the value in a good buy side model is the revenue decomposition, the revenue build. And I've always been a component of a multi-angle revenue build. If you look at a company, build out the revenue 2 or 3 different ways. Build it by product, build it by geography, build it by GDP, GDP growth plus a market share, right? Look at revenue 3 or 4 different ways, because sometimes you can look at seasonality. You can pick up simple alpha in revenue modeling just by applying 3 or 4 different lenses to that. So we have a prompt to basically give me all the different ways based on what's reported in the K that I can help design this revenue build. And I've had revenue builds on names like IMAX that have been hundreds of rows before, and I think actually give you helpful insight into how the business operates. So I'd say the general update, if I sort of start with the conclusion, is that I don't think we're there yet. I can't walk into a client and be like, hey, all of your Excel can be done with AI now. I don't think we're anywhere close to that. I think anyone who says that is wrong, in my opinion. But we've seen improvements, right? 2025 era AIXL was not good. The first version, some of the AIXL tools were bad. Certainly in the pre-coding agent era, the fact that that LLMs are now agentic and can tool call coding is a massive innovation that has shown huge improvements. Why? Because LLMs are natively bad at math, prone to hallucination, and didn't have great retrieval. Attention degradation, sort of lost in the needle in a haystack issue. Multi-document retrieval was very bad. Finance benchmarks were in the 60s. It sort of seemed crazy. The tools were just so bad. Lately, they've shown a big improvement with coding agents, which are more deterministic and quantitatively fluent, and then the ability to pipe in and do connectors to MCPs is a big unlock. I'm still seeing, I think, some issues when I get into deeper use cases. I don't know. My hypothesis is that there's still a little bit of a token bottleneck. That the effective context window, even the agentic system spawning subagents is still not big enough. Multi-document retrieval can be hundreds of thousands up to 1 million tokens consumed. And I asked a Perplexity computer how big one of my models was, and just my Danaher model is 1.18 million tokens, right? And so what I'm seeing as a conclusion is when I cut my model down to one tab, one simple row update, it's doing a very good job. When I have my 6 tabs in there, over 1 million tokens, it's really getting lost. I sort of hypothesize that this is simply a token context window issue. I had some disagreement on that on Twitter that is actually sort of coding in Excel bypasses that context window problem. But that's been my sort of across use cases. The more complex the use cases, the more my skills are ignored, the more simple parts of the task are ignored. So I chalk that up to the fact that the effective context windows of the foundation models are still in the 500K to 2 million range. And some of this may just be, as AI has been, a waiting game for the underlying models to improve. So I think a word on tools, like I don't think there's a complete tool yet. But there's some interesting pieces emerging. I've been a fan of the agentic workspaces. Codex, which came out, sort of updated this week, I find very interesting. Perplexity Computer, I've been a fan. Claude Cowork, I think, is promising, but still a little buggy. Claude and ChatGPT XL, I didn't see that much difference in. They're promising, but still fresh and buggy. Delupa, I'll walk you through a bit. Rogo, I think, has shown a vision of what's possible in investment banking. And a few of their AI XL vendors, I think, that I picked back up. Still aren't there yet, but they've improved quite a bit since fall of 25 for sure. I do wonder on some of these tools how they sort of overcome the compute sort of subsidization dynamic, but that's a debate for another day. One of the things I like to point out to people is the importance of accuracy in the underlying data. One of the things that makes me go mad with Claude is if the connectors break, Claude will go try to find a number on a blog somewhere, which is just a really bad idea. So I've become a fan of Delupa. Delupa has these data sheets, which are sort of AI generated, AI clean. They've sort of long before LLMs. They're not really in a usable structure, but it's a really valuable source of comprehensive data. So it's been one of my favorite MCPs and has been a key unlock in getting accuracy. And so what you can do in these Claude XL now is you can upload skills, you can upload connectors, and that has been an important unlock for me. Why is that important? Because if you one shot this sort of principle cross AI, like maybe we get there where you can one shot and AI knows your intent and it knows by your history that you're a hedge fund person and you care about this part in models versus not. We're not there yet, right? We're certainly not there yet. We're in an era of AI where systems still matter, right? Data matters, context matters via workflow orchestration, agent.md, skills.md files. So you see this if you try to one shot. If I try to one shot and I go into AIXL and say, build me a financial model for Amazon, give me a 3-statement model. It's sort of funny. Like one of the first thing that looks is like, does the balance sheet balance? Almost in none of my models in the forecast period do I even focus on modeling out every line of the balance sheet to balance the balance. What you get out is sort of like I would still chalk it up to AI slop. Like, yes, does this look like something a 4-year-old will build? No, like we're sort of past that. Formatting structure has gotten a little bit better, but it's still not there yet. It's still something closer to that you get out of a FactSet, a FactSet download. There's no decomposition of the revenue. There's no revenue bill, which is, I would sort of argue, in most companies, the number one most important part of a financial model. Really no analytics around the income statement. Summarize, sort of compressed balance sheet, et cetera. If I ask ChatGPT what it thought, what you sort of see is you get a very sort of simple. It says top tier undergrad, early investment banking analyst level. I wouldn't even give it that, unfortunately. So systems approach, as we sit here, April 2026, really important. One shot. Most of my friends were like, "Hey, Brett, I tried to use AI on these things. Like, it just wasn't good." I'm like, "Well, what do you do?" Like, "Oh, I went into Claude and I asked it to build me an Amazon model." I'm like, "Well, yeah, no surprise." A one-shot approach with no validation system, with no steering of the model, no connecting of data, is going to be bad. It's just going to be bad. And pretty much every workflow. Like, I don't think there's that many workflows where that still can be one shot in my experience. You have to apply a systems approach, an intentional design, an engineering mindset, the institutional rigor sort of enforced via institutional data, institutional workflow, and then validated accuracy, right? I'm not going to one shot a model, send it up to my PM, and have one third of the numbers be incorrect, right? And so part of that institutional rigor is shifting the thinking of the financial model. I remember 18 months ago, I was talking about fine tuning and finance tuned models, and we're going to go into the parameters, and we're going to make this model think like a hedge fund analyst via the parameters and the parametric memory. And I don't hear much about that anymore because skills.md files have become so powerful that I can change the way the model acts and thinks simply by putting workflow context next to model intelligence. Why is that important? Well, one of the core issues in financial modeling, almost many use cases, is the underlying quality of the training corpus for finance is awful, right? Investing theory on the open web is highly influenced by Buffett and blogs, which are more often than not, Buffett derivatives. Um, the financial modeling corpus is highly influenced by investment banking, right? So if I ask ChatGPT one shot, I say, if you had to pick, one and only one test of whether I build a financial model for investment research accurately, what would it be? Sort of clowning the model here. It's like, does the balance sheet balance in every historical and forecast peer without a plug? Again, I have no plug. I don't know if I've ever, after being yelled at the first time I did it, I don't know if I've ever built a plug into a three-statement model to support an investment idea. So this is an investment banker. It's not a stock picker thing, and that matters, right? If I'm trying to build 157 models, I don't want 157 investment banking models, right? Okay, so that's one shot. That's fresh out of the box. How do we how do we apply a systems thinking? You've seen the slides in the other seminars, right? We want to understand the superpowers and jagged edges of AI, because if we see that, we sort of know, okay, because of the training process, this is why it does it. I can go back in with a skills.md file and change that. And so that intuition is important. You want to think about intentional tool selection. Your data strategy is super important. Your workflows, prompts, and skills that are customized to you is an incredibly important part of the frontier right now. So much of RAG and retrieval and model engineering has been abstracted into agentic harnesses. What's left amongst sort of the commonality of all of the sort of current leading agentic workspaces is sort of two things. It's the data connectors and it's the skills architecture that basically encodes your workflow into the system. And as I sort of think about my hypothesis of where this game ride is going, is those are the two irreducible elements that need to be addressed. And then a two-tier validation system. How do you systematically, but in an analog way, check the numbers? And a system that enhances comprehension and rigor. All right, so what is the skills file? If you haven't understood skills, it's not that complicated to understand. Go to this YouTube video from Shah Talebi. In 23 minutes, you'll have a basic understanding. It's simply a way to encode. They can get more complicated when you talk about what's sort of deterministic Python call versus how do we chunk skills, et cetera. There's sort of emerging developer community around skills engineering that matters, certainly when you start to scale it across a system. But as a very specific perspective, skills are just a way to encode a process, sort of like a stack of prompts or a menu card of prompts, which is nice because I had 306 prompts that encoded my entire investment process, which was great and impressive. And people are like, wow. I'm like, how often do you use those? I'm like, well, crap. If I have to put in 12 prompts to analyze a new CEO, that's a pretty cumbersome process. The prompt chaining and all these complicated, exotic prompt engineering techniques that I wasted all this time in 2025 learning, I think are completely abstracted now into skills. I can put those same 12 prompts into one skills file to evaluate management team. I can just call that with a / in my agentic workspace, put in a ticker, and the user, it's like incredibly user friendly. I can, in the sort of new investor dashboard, I'm just going to press a button and I get a 10-page report on a management team. It's sort of fantastic how the abstraction of all the engineering has happened. So, skills are really sort of pioneered by Anthropic, but really becoming the standard that work across platforms. Prompts are still a thing for sort of simple use cases, but for actually wrapping your process in an agentic approach, skills are the important context. The wonderful thing about skills, as happened in prompts, where LLMs were great at building prompts. So I never I haven't written a prompt by hand for the last 6 months because LLM capability can write a prompt better. You can get to a very high standard of skills creation simply by documenting your process in a deep, comprehensive way and putting that document next to a well-structured agent and ask them to build a workflow orchestration. And so this is a lot of what I've been going down. Now, I don't think that's an institutional grade standard, but getting 85% of the way there um, it's a really good starting point. And so what I've been doing is, to build this is like, okay, I'm going to go in and effectively, create, I think this is an 88 page, buy side financial modeling and guidebook that talks about historicals and cleaning numbers and basically everything I could think about the financial modeling process that I've collected in my brain and in my educational programs for 20 years. Let me put that into a textbook and let me present that to model intelligence and ask it to build skills. And it's sort of shot. Sometimes I try things like, there's no way this is going to work. And this is one of the things I'm, oh, wow, this is pretty good. So I've shown people this workflow, and I sort of say like start thinking about articulating your workflow context. Create these standalone documents for your own process. For me, it was the notes and process learnings I've gathered over the year, some voice brain dumps, and iterate a number of sort of steps of iteration. What you see when you do that, for example, when I upload my model foundation skill, right? And I asked ChatGPT that same question. If you had to pick one and only one test of whether I built the financial model or for investment research accurately, all of a sudden it gets the right answer, right? Does the model replicate how the company actually makes money, uses the real operating drivers management uses internally? Check. Nicely done. Why? Because if revenue is wrong, almost everything downstream is fake precision. Nice job. Nice job, Chat GPT. A good single test is not does it balance or do the formulas work? Those matter. Certainly they matter, but their hygiene, the highest signal test is whether the model captures the business engine correctly, right? Can every major forecast line be traced back to the three most deterministic key drivers? And the CFO test, if the CFO read the revenue bill, would they say, yes, that's how the business actually works, right? And so this is just a demonstration of the power of skills, right? To be able to go in and articulate all of these concepts are concepts that I've articulated in my workflow document that I presented to model intelligence in the meta skills creation process. And it accurately captured those back in the FE model foundations skill. So I've rectified the native challenge of the financial model corpus that's investment banking heavy. So this is sort of what I've been building out. It's the model foundations. It's things that are always loaded: formatting, philosophy, tab architecture, the exact way I want it. It's a raw build from scratch. It's a model updater. It's an audit model. Hey, before I show this model to my PM, go and check every number, every formula. That's working quite well. The qualitative to quantitative. Hey, management said this. What does that mean for EPS? This company lost this contract. What does that mean for EPS? I think that's a huge hurdle to jump over in terms of automating, sort of automating ourselves. Model earnings prep, scenarios, FE key drivers. What are the three things that matter? And so these are the 8 master skills for financial modeling. And I'd say, again, when I keep the model simple, don't overload the context window, they work quite well. When I try and have it do too much, certainly my raw build skill is just not working. And I don't know if it's just too complicated or what's happening, right? And so I'd say I'm sort of seeing whether it's Claude Cowork, Cursor, or Perplexity Computer, this sort of convergence of this super app strategy where there's one agentic workspace. All I have to do is go connect and go get my connectors and upload my skills. And you know, I'm not sort of steering people to use Perplexity Computer. You could take a skill embedded in Perplexity Computer, take it over to Cursor, be like, here are my 8 modeling skills. Can you revise these that are in line with how Cursor would like to see the skills? And that takes 15 minutes to do. And so ultimately, what I've been doing is building these model workspaces where this is in Perplexity Computer. I have a workspace where it's a new model creator or model validation or a model updates. I can upload the model. Perplexity Computer doesn't have an Excel app yet, and they only just recently got connectors to Delupa, et cetera. I can go in and upload a model into model validation, go check this model, which is a workflow I quite like. I think is a big unlock. So generally, the great news about the trajectory of AI in finance is, prompt library with 300 skills is really hard to use. I think UI and UX will matter a lot. So building these spaces is going to be really important, certainly to move beyond the hacker era into the broad adoption era of AI in finance. So I'm starting to think about all these different UIs in a case where I could have just these different buttons to push, right? So I could have my Uber model here at the top. I could upload my Uber model, and I could have a UI where there's an update refresh. I just press the button, it updates it. I could have a research model, drill down into each line items. Let's go do some, let's go research, revenue per ride, et cetera. Validation and sensitivity. Then go validate, the formulas and codes and audit and do a bull-based bear and understand what's baked in the stock with the DCF. Challenge and sharpen. Let's go push back on these estimates. Hey, you're modeling an acceleration in volumes, but Waymo is expanding into all these markets. Will that lead to a market share? So having these debates to help you develop a variant view embedded in the model, and then ultimately, how do you identify differentiation out of the model? So I think this sort of UI game now is interesting with each of these steps in a model workspace being an underlying skills architecture. I'm starting to think about for firms, like if you have a firm of 100 investors, how do you build these in collaboration with the engineering team? And then all of us to roll this out to investors, just like, here's your modeling UI, right? It just works. Press this button and be surprised and delighted by what you can do with your financial modeling use case. Again, not there now. Not all of these buttons will work now, certainly not reliably. But I'm sort of taking on, making a wager on that we continue this trajectory of improvement. And could this be a 26 thing where you have something like this? Could this be a 27 thing? I'm starting to think that maybe that's true. All right. A few other considerations, and we're getting into the 3-level test. One thing that I'm still seeing, this is really annoying, is the numbers still aren't correct in a few of these model updates, right? Claude was the worst performer on these, unfortunately. And I asked, why the number's wrong. It says the reason is simple. I pulled the historical numbers from web search results and secondary sources, news articles, data aggregators, rather from the actual 10K filing. If I had an analyst that updated a model pulling from a news report, a news article from Benzinga versus going into the 10K, that would definitely get a bad analyst review. So these are still jagged edges that need to be ironed out, right? And so part of the reason we're not there yet is these things still happen. The connectors break. Claude forgets it's connected to Delupa. So you need to remind it, don't do that, even though in my skill, right, I explicitly call out the sourcing architecture. So data MCP is sort of critical for these in the flow quantitative use cases. It's part of the reason why I think, through much of last year, I would hear a lot of firms trying to use AI for earnings season, for morning news monitoring, and for earnings previews. And I would point out the risk embedded in those workflows simply because there's no natural validation loop. If I'm waking up at 6:30 a.m. and I get an AI alert that my company cut guidance by 7%, right? And there's some volume in the pre-market and I want to pump my position in the pre-market, but that's a hallucination. That's a real problem. That's a real problem. And so I've sort of had those I've had those workflows as red lights in my schema. Um, Maybe they're moving into yellow lights now, where I've had green lights as idea generation, sniff tests, where there's sort of a natural validation loop. I make that point to say when there's no natural validation loop for low latency, high impact use cases, you had better be sure that your data lake and API connectors are really, really reliable, that you have a validation. And so it's particularly critical for earnings news, anything without a natural validation path. Don't use ChatGPT for that. A much more comprehensive system is important. Use it for a topical brief, a web scrape of, learning about the Medicare Advantage world. That's great, but be careful. Just be careful. The great news is that when I get the Delupa MCP connector and I start to do my level one test of update a model for the quarter for Amazon, I do I updated it by hand, and this is my sort of checking function. Guess what? All of a sudden, it does it well. I tried to move out of Excel into Claude Cowork and to Claude Code. I had so many issues, and it must be a skill issue. I read all these, articles and tweets and YouTubes about Claude Code and VS Code and Claude Cowork being great. My experience is from time to time good, plagued by approval fatigue, failed extraction, doing hard Yakka, having to allow once every time there's a web search. I just don't find it very user friendly. Telling it over and over to pull from the filings, and then we're going to the website again. And so, rounding numbers issues, updating a model and just pulling in numbers that are rounded. No, I don't want that. I want accurate numbers. Like this matters. We don't want to round numbers. So moving beyond, Claude XL with the MCP connector, I still had some issue. So I have a stack of modeling evaluations. Some I'll share, some I won't. I'm not so hubristic to think that anyone from any of the foundation labs cares or is even watching this to go and retrain the models based on these evaluations. But just in case, I and am building a broader set of model evals, thinking about some RL sandbox, et cetera, to continue to do that, which is interesting. But for this use case, we'll sort of talk about three levels of evaluations. Number one is something I can hand to a liberal arts intern. Two would be something maybe an investment banker can handle. Three would be like a banker who knows something about buy-side modeling. So a super simple task, the sort of the prototypical simple task is, and at Amazon, if you cover, the model is pretty simple. Not that many adjustments. You get a below the line add back from time to time, but they don't go crazy with the non-GAAP. It's a pretty simple model, about as simple as it can get. Just update this one quarter P&L, right? And I moved over all the formulas. All I needed for this use case is find where the numbers need to be input. This links down to revenue. This links down to operating income. Just update the numbers, right? And Claude with Delupa, 33 out of 33. Claude without Delupa, it was 1 out of 33, and I don't know where the numbers were from. They're trying to pull from the web. But when I use the connector, great. Perplexity Computer, which this is before the Delupa connector, I ran this analysis. It had the perplexity numbers, also great, 33 out of 33. To have an extra set of checks, I'll move this into my validation space in Perplexity Computer, test whether this model was updated for the Q2 25 model update correctly. And in this case, this was one of the Claude examples. It actually caught a few of the differences. I don't know exactly why, but Claude without MCP had small differences. So it goes and does a line by line test, and I didn't do this on 100 use cases, but on the 10 use cases where I had the perplexity validation space check the numbers, it was right. It was sort of accurate in the checks 10 out of 10 times. So I say in general on level one use cases, we're kind of there, right? We're there. These simple model updates, simple analyses, it's really good, some really good evolution. I'd say that's an improvement from where we were in the fall of 2020, 2025. Level two, a little bit more mixed. I took an Uber model that was 4 quarters out of date, and I said, Perplexity couldn't do this. So I gave this to Claude using the Dual MCP FE model update. And this was like one of those moments where it's like I was delightfully surprised. I'm like, I don't think that it'll be able to do this and roll forward the estimates and keep the formatting. And it basically one shot of this with the model update, right? This is helpful certainly if I'm a generalist or a broad specialist. I'm not updating a model every quarter. This was 4 quarters out of date. Add some rows, roll forward the formatting. This is pretty nice. Like that might be a 45-minute, hour-long exercise to get an Uber model up to date, to be able to press a button and have that done in Excel. I was pretty excited. I was pretty excited by it. Now, I ran that through the validation space, and it did make a few mistakes, right? But I was encouraged because my model validation space caught it. There was a couple wrong signs in the net income, I think an NCI input. It missed 200 million interest expense. So a couple more complex below the line things. But out of 145 inputs, it went through and said that 140 were right, right? And notably, it gave me the 5 that were wrong. So I could go back in and fix those 5. So I've sort of like I use this slide as like really great news of the progress we've made, simply because agents directed by skills can go in and validate and check models, right? I had struggled so much intellectually with AI Excel, this concept of 70% accuracy on finance benchmarks. It's like, well, how do I identify the 30% that's wrong? And so the answer to that now is like create a validation workflow, create a validation skill. Before you take any model that is sort of accurate, go through and actually run it through a systematic validation. One step I didn't show in this webinar, but I've done elsewhere, is bring it back to the thesis. My thesis on Uber hinges on these 3 points, right? To help me have further understanding of the accuracy of the model, give me a checklist of data points that I can go in and check in the model to ensure accuracy. So that's another way, sort of, that give me a checklist of things to go in the model. I could hand that checklist to an India team to go do that by hand checklist. Even if I continue to use India and train India on this, I could take a 20-hour process down to 2 hours with this system. So I get 10x productivity from an Indian modeling team. So there's all sorts of different workflow dynamics. I think the other thing you're starting to see evolve too is click-through visibility. Part what I really like about the DeLupa structure is be able to click into a tab and see actually where that's from. So I think that will be the institutional standard, is click-through visibility. All right, so I'm riding pretty high on the Uber accuracy. So I'm like, all right, let me give it something that's harder, right? And a harder one would be Danner. I hadn't touched Danner since Q1 of 2021. This was really built around, at the time, there was an acquisition of the Cytiva business from GE, and you had this sort of really big COVID tailwind in the business that I was trying to sort of figure out and decompose so I could see what the core was versus temporary, et cetera. Do I short this thing on a temporary tailwind thesis, et cetera? So, I had sort of the model architecture built around those two pieces. So part of updating a model is like, well, I don't want to build the model around that architecture anymore. I need actually a re-segmentation. I need a restructuring of the business. And if you have covered Danaher, you know that there's kind of a lot going on. So I had a model that's 5 years out of date. That's hard, even if the model structure hasn't changed. But there's a different modeling emphasis. It was Cepheid COVID testing and Cytiva sort of, M&A coming in. The 2026 emphasis is more about a possible bioprocessing acceleration and Massimo integration. So I need to just do some rejiggering of my model, restructuring of the model. I want to sort of model in the Massimo integration and see how that impacts revenue and EPS, and actually put that one-page accretion dilution into my core operating model. So that's a big exercise, right? So when people say AI is, financial modeling for Wall Street is solved, and I was like, they're really even close. We're not even like in the neighborhood I guarantee you I have one of the deepest skills architectures and context architectures of financial modeling flows. And we're not even in the neighborhood of getting close to that right now. Um, the other challenge is Danaher changes its restructuring, right? This is sort of a maddening thing for those who are building deep financial models. You go from three segments to four segments to three segments. I basically need to recast my entire financial model, and I don't want to lose the 10 years of history. So I add rows below it. Sometimes I'll try and reconcile if, old to new. I want to see continuity of operating results over time because history lessons are helpful in better forecasting the future. So there's been some real restructuring. I got a little excited for a minute here when I updated into my FDA model skill. Perplexity Computers, identified accurately that this model needs a complete structural expansion. I'm like, well, check, yeah, it does. Um, it pulled up in 2023 that there was they had spun off the Veralto business. I'm like, hey, listen, you're doing a pretty good job. Like, keep going. It had pulled in where the data was to come from, which was part of my FD modeling skill. Like, yeah, go into the K's and Q's, go into the press releases, like go into an EPS reconciliation table. Like, yeah, let's go. So promising. I wait 5 or 10 minutes, and this is what I get out. Right, there was sort of no formatting, roll forward, and it's sort of the core heart of the business that I wanted to see. The revenues, profits of the segments, it just completely skipped. And so I put in the P&L poorly, and that's about it. I didn't even consider the restructuring, even though it sort of, it caught that the model needs a complete restructuring. It wasn't able to add rows and rebuild the model around the way I wanted to do it. I didn't even consider that as a judgment call, even though I uploaded my Danaher thesis into the context window. And my conclusion is just like there were just too much, like 1.8 million tokens and all the other documents, and model intelligence isn't intelligent enough to do this yet. Was my conclusion. All right, so I could give up there, or I could try to think about different areas. One of the areas that I started doing is like, okay, like how can I complete this task in a way to have a human in the loop. So I'm not going to spend 20 hours on it. It can't be done in an hour. But maybe I can do this in 6 hours, right, with some human level assistance. So the pivot from that experience was help me think about AI Excel as a partner, right? Part of that is a step of chunking down the model build, right? What are the steps I want to do? What are the steps I want to do in building a model, right? We'll go through this in our forthcoming, financial modeling course, where we sort of put all of this into skills architectures. We do this by hand, and then we sort of do the chunking system. But these are sort of like the 19 steps, right? My brain is either blessed or cursed with this sort of like decomposition thinking to really kind of chunk things down into individual steps, which is helpful if I'm going to assign this to an intern. Like, hey, these are the individual pieces. So that's sort of where I'm at right now on AIXL. It's the human in the loop. That some of this can be done with modeling process, sort of workflow architecture via skills, but there's still a lot that needs to be done by the human for the time being. So what does that look like? It looks like, I have to go in and add the rows, add the new columns, add the new segments, right? What I did in this instance is I went through and manually restructured all the segments, right? I went in, added rows, put my old rows below, and I did the input for the first year and for first quarter, right? So after this, I'm like, well, okay, that took me some time. But can I say after that, I said the highlighted range is a structure that's reported in Daniel's press releases. Please go and pull this information from the highlighted range, update these numbers below. Guess what? It did a really good job at that, right? Once I sort of steered it and created the structure, I lowered my expectations for what AI could do, and actually did a great job. This was again Cloud with MCP. It even did a situation where in Q1 2025, Danaher hadn't yet reported a segment breakdown of other operating profit, But there was a footnote in that quarter talking about a $15 million impairment related to a facility in the biotech segment. So it took the liberty of inputting that number into the other operating profit. That's a pretty good job. Like, clap it up for Claude. So it caught a footnote adjustment in a situation that hadn't been reported on the face of the P&L. I'm like, okay, cool. Like that, I like that. That was pretty. That was pretty. That was pretty impressive. So, I found it helpful to sort of think through the resegmentation. I went and built this on my own, but just a simple act of asking the questions of like, hey, when did Danaher change their reporting structure? All right, it started in Q3 23. Thanks. That saves me 3 or 4 minutes from having to go into the filings, check to see where it's happened. All right, so the three segment structure exists today, only goes back to Q3 2023. So having this thing is like a chat bot in the Excel structure where I can ask questions. It's helpful just to highlight this is when the new reporting structure happened. This is when the spin happened. This is when the Cytiva acquisition. This is when the dental spin happened. I found that to be helpful. I found that to be like a helpful structure, right? I asked this structure of the new reporting of Danaher to go back in history, and it said, hey, before Q4 2024 cannot be filled because they didn't report it, right? We can either leave it blank, allocate the DA ratably, allocate the segment share and revenue per quarter. I don't really want to do either of those, right? But I think I said go in and put NAs in all of these cells, right? That's helpful. That's helpful as a PM if I'm looking at analyst models, like why did they report biotech adjusted operating profit in Q4 24 but not before? I could ask that question and be like, oh, they didn't report that before. This was a new reporting change. And so the ability to have a chatbot in Excel, I found quite helpful for this process. Even the process where I had to go in and build it on my own because the capability wasn't there. It reported, hey, it's a disclosure rule change, not Dan or hide anything. ASU 2023-07, which was I guess a FASB rule, improvements in reportable segment disclosures issued in November in 2023. Like, oh, cool. I thought that was pretty cool, right? To be able to go in and just see why the reporting has changed. So I'd say to give it a pretty good there, right? I said it can take this 20-hour process down to an hour, but maybe we could take it down to 6 hours. So I took that first step of this process, build the first step for them, almost in a way of like I had an intern, I say update this Danaher model with no just grunting at the intern with no specific guidance. Like the output probably wouldn't be good. But if I was going to give this to an intern, it'd be like, hey, I updated the first row for you, first column for you. Go back and fill in the last 3 years with that. I'm probably going to get a better output, right? And so, um, I always sort of scoffed at the humanization of AI, chatbots, word calculators, et cetera. But like agents, I kind of like bringing that back a little bit of like, okay, like I updated the first one for you, right? Take this process and go and update those back. And so it did a pretty good job of that, right? The ability to go in, populate the numbers were great. I continue to have some struggles even through this process though with Claude and MCP. I asked Claude to go in and update 5 years of balance sheets. And it said, given the volume, I'd suggest breaking this into a fresh conversation, just focus on the 2022 to 2025 fill. I didn't really think that this is that much of that big of a lift. Certainly not relative to press a button, build a model from scratch. But Claude had some issues here. The connection timed out. The chat sort of ended, and maybe I should have deleted this. This is my frustration. Frustration with working with Claude. The capital come on, or the HUD just do it. So probably not one of my better moments, but sorry, Claude, for being a little bit rude to you. Still not perfect. It said this balance sheet populate is substantially larger than typical. Like, what are you talking about? I just says 5 years of history is for a pretty simple balance sheet. for some reason the honest assessment is like quite triggering to me. Like I want to give you an honest assessment. Like 5 years of balance sheet updates is just substantially larger than typical. Like, what is typical? Like this is exactly typical. Um, so I have a mixed relationship with Claude right now. I wasn't too happy about this simple use case. Certainly, if it can't do this, it reliably, a simple 5 year model update, the full model restructuring, it's not there yet. To try and do this, I experimented with a bunch of different tools. I downloaded Delupa Scout. I'm not sponsored by Delupa or any vendors, no financial relationships. Um, and sort of on the belief in the prior that the underlying quality is good. So then I said, okay, please update my balance sheet and cash flow statement here, all the quarters and the years up to full 2028. And that, completed, I didn't show an example of it, but it completed it sort of perfectly and added click through visibility to that, right? And so another example of a helpful copilot, Boston Scientific, I'm updating the model there, how to resegmentation, similar thing. So just asking the questions in Excel I found really helpful. Why not use FactSet CapIQ to do this? If I go back to the 5 use cases, we talked about in the model, this sort of output is not going to reach institutional standard. For generalists, I get the feedback a lot. Hey, I just use Canalys models. They've gotten much better. The structure is more like a structure you'd see from one of my models. They have strong generalist adoption. For generalists covering a broad space, it's a strong solution, in my opinion. And particularly if they can alpha sets can figure out how to integrate the Canalys modeling architecture with the agentic workspace, the agentic capabilities. You can see a vision where you're tying in the AlphaSense expert network calls into the key drivers in a Canalys model, giving you a variance versus consensus. That could be pretty slick, right? That could be pretty slick. So I'm more positive on AlphaSense than I think most, just given the pieces they have, and I think what they can do. Having sort of hit a wall on a 5 year balance sheet update, I had very low expectations for the investment banker with buy side experience, which is basically saying, "Hey, here's my Uber model. Go build me a model like this from scratch." It was nowhere close. I didn't even do an example, right? So that's sort of where on the level 3, I'd say mixed feedback, right? Not great, certainly not. If you're at a hedge fund saying we want to hand all of our financial modeling over to Excel, to AI, I would say, please don't do that. That's a very bad idea. There's just still a lot of jagged edges here. Part of it, I think, is just the fundamental intelligence isn't there yet. Part of it is, context window. Part of that is context windows. There's just it's still too token consumptive of a task to do with institutional grade. As a human in the loop structure, downloading Claude or GPT or Delupa, or Shortcut or Index as an app, having that as a sidecar, asking questions, updating certain elements of the model while you work in other pieces of the model. It's pretty slick. I think we are there for sure. After doing this a few times and be able to ask questions, it would be kind of hard to go back, right? It's hard to go back if you can one shot 5 years of history with the Lupa Scout. It's pretty painful to go back and do it by hand. I think you can do it faster, and I think you can do it more, sort of just as accurately. Last point I'll make is it's really like two parts of a financial model. There's a historicals, which we've mostly talked about today. Those are table stakes, but like really important table stakes, like having accurate, clean financials, normalizing for one-time items, segment KPI, unit economic views, gap to adjusted. It's very, very important, because that's the foundation of what your forecasts sit. That's the foundation of your evaluation of the business momentum, business quality sits. So very important. Also, like table stakes, like alpha doesn't necessarily come from just the historicals alone. You'll get insights around the business. More of the alpha comes from a differentiated forecast, right? The three driver discipline of like, what are the 3 drivers that really matter here? And so much of the Pareto optimization approach to this business is like, how can I run at these 3 drivers with incredible rigor, develop a differentiated view on those three drivers, right? So we show this framework of what's possible. I have a stock. I'm going to break that into 3 key drivers. I can develop seamless, augmented, automated key driver differentiation work. I can overlay an expectations engine. which is I think one of the holy grails of quantum mental investing, a set up pattern recognitions and base rate probabilities. All of my models, I have key drivers and sensitivities. I can do the thematic betas and narrative betas, et cetera. Implied revisions, proactive alerting system, customized risk. Hey, it looks like from this analysis, from what Pierre said at the London conference, and this data, and one of our channel checks that the key driver and market is rolling over. You know, flashing yellow light. Check on that. Maybe we want to punt the idea. This is sort of like I wouldn't necessarily say the holy grail. But what we're working towards, what I'm working towards, and trying to make a reality in this space, right? So a company like HCA, how do you code in 3 key drivers? What's the sort of typical work stack you would do on those key drivers manually, right? And how do you scale that? Like fundamental investing is never scaled. I've never feel like I had true, like generally it was like beyond idea 12, beyond idea 15. Like I always felt like my 16th best idea was like really bad. Part of the reason I did, felt like I was a better Tiger Cub investor than multi-investor. Because a lot of this work just takes a long time, right? Like there has been really no shortcutting all of this work that is required to have differentiated insights on a broad set of companies. Maybe that's changing. And I think one of the interesting workflows, one of the abilities we can have is to scale fundamental investing more, to create an automated Excel structure where for each idea under coverage, 157 names, I can go in, human in the loop process, identify the key drivers of all names, right? Yes, 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 right? And then you name this is adaptive over time. These 3 drivers today might not be the 3 drivers in 6 months. Market's a Bayesian adaptive approach, but maybe monthly I can go in and sort of revalidate and configure my system. These are the 3 drivers that will matter. I can weight those into, hey, 50% here, 10% here, 40% here, et cetera. So I can have a reweighting algorithm. Then I can create agentic processes to go in and evaluate all these key drivers with external, internal, alternative data, management notes, sell-side research, web scraping, et cetera. I can flow those conclusions back into the financial model through the financial model architecture with my operating leverage assumptions and unit economics and P&L flow, connectivity of the 3 statements, and the output of that model, right? Which is sort of the manual output today is an investment view, right? My estimates relative to consensus, the sort of adaptive impact of my risk reward, the business momentum considerations, is the business getting better or worse, right? The model starts to emit an investment view, not just numbers, right? This has like been sort of science fiction and still science fiction, but like I think we're getting closer. Like some of the pieces are there to start to do that. Some of this comes from sort of core frameworks. One of the core frameworks we teach in Analyst Academy is incrementalism, right? Trying to always identify the incremental change. You lose a contract, win a contract, revenue. How does that flow through? What's the incremental? What's the EPS impact? How does that change numbers? What should the stock do based on that number? So part of this is building an expectation engine. What's the expectation on this data point? What do we think is going to happen? Is that already in the stock? How does it change numbers? How should the price move off of that, right? Automated trade, there's opportunity for automated trading associated with this too, where it's like, hey, something happens, the stock's off 6, it should be up 3. Like that's a big alpha gap. Certainly in earnings, you see a lot of those moves where stocks gap down 3, finish of the day up 3, and those 4 or 5 point alpha opportunities are really a function of speed of comprehension and speed of behavior, right? And so a lot of it is just simple signal versus noise and incrementalism that this agentic system can help you to sit on your shoulder, developing that wider research funnel, understanding attribution, the signal, the stock price linkage to KPI, the exposure materiality, and seeking the inflection. This has been a deeply artisanal process for the history of investment research, and I think we're at an interesting threshold where that may be changing. So I'm starting to build some of the architecture around this, some of the skills, and putting this into actually the workflow orchestration to say, okay, where is this going to impact the model? Putting that incrementalism framework into a skill. Take this news and try and quantify it into an EPS number. Is this signal? Is this noise? Does our thesis maintain integrity? Et cetera. So this really feels like the future state, which is why I'm running after it. so aggressively. So what's next? We'll have one more of these free webinars next Thursday to sort of cap this exercise process. For me, a lot of this webinar series has been just getting my thoughts on paper. We have our podcast Invest with AI coming soon. We put a date on AI Accelerator, so we will go more deeply into this, all of this stuff, June 8th. If you take this webinar series as what's possible to do, Accelerator will be how to do it. We'll sort of get into these individual workflow labs month by month. Is really the core part of it. And we're taking a lot of this IP workflow context, training, and implementation into enterprise partnerships as well too. So that's really the core of what we're going to be doing. This foundational seminar, which is sort of 3-hour on-ramp to deploying agents in the investment process, and then these workflow labs where we'll take these individual pieces and okay, this month let's go into short ideas and how you can augment a short sale process, short identification process with agents. It's really interesting stuff. At least I find it very, 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 very interesting. And we're in development. We slow this down a little bit just because this piece I think still needs a little bit of seasoning. But a core part of what we'll be doing at Fundamental Edge is the multiple pillars. We want to start with the foundations, build a model from scratch, how to use and think about a model. And this is sort of the old way, right? But we want to start bringing in all of our programs to sort of accelerate thoughtfully with AI. I believe maybe I'm old school. The foundations are critical. You don't want to jump right to pillar 4 with anything because you don't have context and et cetera. And part of reason I struggle with coding agents, I couldn't debug and I couldn't tell what's good. And the reason I can make these Excel agents work is if they break with the Danaher model, I know how to go in, take over control, and rebuild the model in a way that I can sort of get through that gap. So my old school mindset is the foundations of how to do this job are probably going to be more important than ever. Certainly the ability to articulate it and have a process around it will be more important than ever, because if you don't have a process, there's really nothing to accelerate, nothing to augment. But if you can take a great process that took you 20 hours in the past, takes you 6 hours in the future, all of a sudden that starts to get pretty interesting. All right, so those were all of 97 slides I had. We will take some Q&A now, and let's see what we got. Will there be recording? Yes. Will there be recording? Yes. Say you cover oil and oil prices as a driver of each company's model. Is that a good use case of AI? Yeah, I need to think through this. I need to think through how the actual technology works. But the way I've seen industrial models built in the past is historical correlations of all the macro KPIs sort of embedded in a financial model. So if I'm covering an airline, right, I want to see all the operating statistics, RASM and CASM, et cetera. But I may want to see TSA volumes in there. I want to see any other data that's publicly reported. And maybe in the forecast period, I want to have an explicit, cost per seat mile tied to a oil price forecast. This brings me way back because I was an investment banker for Delta back in the day, way back in the day. So you'd want to have different scenarios, but in theory, you could have an agentic update of that data series in your financial model. So every time you open your model, now things would move around a lot, but maybe you could press a button to give you an updated number to see, okay, based on this oil price, what happens to my number. Now, I don't know if there's alpha in that necessarily. That's maybe more beta, because I think that, stocks that have that sort of obvious input get coded pretty quickly, and they tend to be fairly efficiently traded vis-a-vis a macro input. All right, I have someone who is 1:30 a.m. from Europe, so I'll take his question. How do you see this with private equity sourcing to investment committee? They don't need so much of modeling, right? Would a software which covers this proper industry-specific IC memo before making a bid? Will PE buy this? I don't know what private equity will do. I think the interesting part about agents is agents are a flexible substrate. So I think what we're focusing mostly on is like helping people understand that substrate, um, helping people understand sort of adopt an engineering mindset around their own investment process, mapping their own workflows. Um, and the reality is, like, if we work with 100 people, like, they're all going to have 100 different ways they want to do that, just as 100 different investors will have 100 different Bloomberg launch pads. Um, that's the promise of agents. It's not there's one right way to do thing. Um, you might scoff at the way I build my models, and I might scoff at the way you build models, and that's great. That's part of how this industry operates. I think each firm will have to think about how they adopt this in their own way. How much of the balance sheet do I model? I don't have a model here with me, but typically I'll model every input historically, so I can run the analytics, your cash conversion cycle, net debt. It really depends on the type of company I'm looking at. If working capital is a big, I generally will model three pieces on like a decomposed piece. I'll model the working capital cycle out and a cash conversion approach. I'll model out the net debt to EBITDA, and I'll model out the CapEx cycle. And I think there's sort of a Pareto optimization approach in public companies because when you're covering 150, 150 companies to model out, to take 8 hours to model out the balance sheet of a net cash business um, is not a great use, not a great use. So if I'm looking at something like Amazon, I probably want to spend a lot of time modeling out the CapEx cycle. I want to see like how many dollars are going in relative to revenue, when that could peak, et cetera. But maybe I'm not that worried about the net debt, right? Because it's like there's not, Amazon's balance sheet is healthy. So I think every model looks a little bit different. You're adding customizations to try and develop insights on the key drivers that that key drivers that matter. All right. Um, how do we get the fundamental edge? Modeling guide. You don't. These are sort of my proprietary IP that I'm putting together. I'm putting these into skills architectures. Um, these are things I'm not going to release broadly. I think we're working on a handful of more enterprise grade relationships where we'll come in and do the full enablement and bring those guides and bring the skills architecture. Um, like I think everything's changing a lot. My core business trains humans. So we're trying to figure out, what the future looks like for us as well, too. How will those humans be trained differently? Um, can we start to train computers more? So we're thinking through that as well, too. And part of that is being thoughtful about sharing our IP too broadly. From Antonio. Hello, Antonio. Nice to see you. You mentioned connecting to the MCP a lot. Have you tried simply providing all the full PDF filings and asking the model to fill in historical data? Does that work? If not, would you recommend any MCP, or is the Delupa the one you would go to, or others to use? I don't, I'm just going to give you a little bit of secondhand what I've heard. Um, PDFs, multi-document retrieval, even simple things like tables have been an issue in the past. You've heard a lot about like optical OCR, optical character resolution. You hear about parsing. That's a little bit above my pay grade in terms of understanding anything beyond what I hear. Um, I hear that MCP is sort of a workaround to that workaround to OCR, workaround to PDF parsing. There also is this debate, which like I also can't really opine on, of like, is MCP too brittle? Or do we do CLIs and APIs, et cetera? So I'll continue to observe that debate, but I don't really have a great viewpoint on that. There are some other MCPs emerging. It's financial modeling. Is it financial modeling data? Just ask like ChatGPT with the MCPs. FinChat is another one. Um, I think they changed their name. So there's a few other like relatively low cost MCPs. FactSet has an MCP. I'm a FactSet user. That was a $10,000 add-on to use their MCP. So I did not pay that extra money. Um, so I think there'll be more MCPs out there. from Gary. Can you give more color on the different AI, ChatGPT versus Claude versus Perplexity versus Gemini? So this is my, not everyone agrees with me. I'll give you my hypothesis on where this is all going. When Sam Altman talks about the super app strategy, that to me is like that resonates with me. Um, I think this is all going into the agentic workspace where you can very easily get your connector set up and your skills uploaded. Cursor was a delightful experience to get that set up. Claude was a really painful experience to get that set up in Claude Cowork. I set all this up in Cursor yesterday in like under an hour. Um, so I think that's what you're seeing. You're going to have these agentic workspaces that have the tool, that have the hands of a coding agent. They have web scraping. They can update documents on your computer if you want them to, or you can turn that off if you don't. Um, I sort of wonder if this is going to be single model or multi-model. Um, Perplexity gets some hate amongst finance use cases for the years of spamming that Perplexity is putting Bloomberg out of business. Um, Perplexity Computer has been a delightful experience. I think it's the most user-friendly, the most consistent tool. Like Claude will be very nerfed, like Claude will be great one day and not so great the other day. That's sort of a challenge, particularly if you have this great system, you put all this work into it, you upload your skills and your data on Claude, Enterprise Claude, and then you have earnings season and it's nerfed on earnings season. That's kind of like a problem, right? So this nerfing issue, this throttling issue, I think is a real not great. Not great if I run out of tokens and I can't upgrade. Like some of that it gets handled on API, like enterprise grade API basis. But there's a debate on whether the harness API, blah blah blah. So that's I'm still sort of in the perplexity computer camp. Um, I my like if you had to push me, I think the winners are going to be the vertical players here. Just as we're seeing, Harvey has been a little bit of a preview in the legal environment. Um, People are like, why would you use Harvey when you use Claude? Well, it's like, actually, when you get into regulated industry, data, enterprise grade security, usability, forward deployed engineers, like all of that focus, right? A simple thing is like, ChatGPT is hiring investment bankers, but not hedge fund people, right? Um, so some of this is just speed, some of this is focus, some of this is a specific build around. Um, and so I think that I don't know if it may be Alpha Sense, it may be someone like Rogo. Like I think that one of these vertical players will probably be, listen, like even in the terminal space, you have CapIQ and FactSet and Bloomberg and et cetera. So I think this is going to be a massive market. There'll be room for many, many players. But if you had to press me, that's my belief. I believe that just like Harvey has now built a very big business in legal AI wrapper, I think that there'll be a very big business built in finance AI wrapper. I didn't believe that for the record, September 2025, but I believe that now. Have you tried Shortcut AI, one of the only Excel integrated LLMs that have processed complex toggles and formulas, but also very good at following natural language instructions? I try not to, I, yeah, I try not to give too much feedback on like the individual, because sometimes when I say bad, when I get bad feedback, then it like overwhelms my inbox, and the vendors want to. So I did not like Shortcut when it first came out. I tried it recently, like it has improved a lot, and so I think Shortcut now is something to pay attention to. And and it did a good job in all of these tests. I don't want to get to the point where like I'm showing six vendors and one gets an F and then the F's always mad at me. And so yeah, I think Shortcut's one to keep an eye on for sure. Um, they've definitely been, I think, focusing and iterating pretty quickly. Some of this, again, I think comes down to this focus area where if you're just going to do Excel for everyone, you're going to miss the nuances. So some of it is how do you pick a lane or have a flexible substrate where you're pulling in these skills easily. Uh, Alex Castro, have you seen any use cases for industry supply demand dynamics outside of just rhetoric? For example, aggregating hyperscaler CapEx plans or utility CapEx spending since that can later arrive. That's a really good point. I spent so much. One of my other this you just gave me an idea, Alex. So thank you for that. One of my jobs when I was a junior analyst on a consumer team, 7-person consumer team, was to aggregate the comp sheet, same store sales sheet of across 120 global consumer businesses. Go in. Now they had different reporting. Some reported half yearly, some had Jan year ends. You had to quarterize that. Oh, it was such a pain in the butt, man. You gave me an idea, Alex. To be able to do that now would be really great across consumer to have just an updated same store sales tracker, industry P&Ls. Like in Analyst Academy, we walk people through building an industry P&L, and you see all sorts of dynamics that on an individual basis you don't necessarily see, but you see it in aggregate. You see that certain industries go through peaks and troughs and predictable peaks and troughs in margin and ROIC. So the ability to do that, not only do that, but update that on an industry basis is really interesting. And the ability to aggregate hyperscaler CapEx plans, put that into an industry model, show that over time, update that. That feels like you probably have to again sort of design that a little bit, but then once you have it designed, having it updated every quarter, yeah, it's a good idea. Thank you for the idea, Alex. Let's see. Have you started with the Q1 23 model and tried to update with Q2 23 and then repeated that as an eval? That could recur to get your current. Yeah, just do one quarter at a time. Yeah, that would be one way. That'd be one way to do it. How do you recommend codifying the investment process as a junior analyst such that when you encode it into skills, it can interpret the process and help extract insight? And how do you think we should iterate on this process as the models improved? This is my advice for this is my advice for junior analysts. Don't try and do too much with AI, especially if you're PM and supervising analyst um, are truly there to support and develop you. I think the more severe risk is trying to do too much too early. Find ways to go deep. I think the obvious use case for junior analysts is to use AI as a deep dive tool, sort of like almost even more the chatbot use case, less the agent, more the chatbot use case of deeper understanding. And again, there's 3 ways to read a book. One, read it the normal way. Two, cheat and read the cliff notes. And three, read it, but debate it with a really smart friend, right? Or a professor, right? Um, and what you're trying to do is turn AI into that professor, right? And so that at the end of that experience, you have a much deeper comprehension. And so my advice to you, Ideal, is focus less on codifying and augmenting your process as a junior and focus more on really understanding the businesses, understanding the craft deeply. Because if you start to codify and augment too early in your investment process, you really risk a critical you really risk bypassing the lived experience, the muscle memory of doing this job. One of the things I've started to develop too is our research playbooks for a junior analyst. And so if I'm a PM, let the PM do more of the agentic work. And on certain ideas, I've given like a 5-page, like almost checklist, like, hey, go read the 10K, check these calls, talk to these 3 customer checks, et cetera, to give some more guardrails around what a junior analyst can do. So there's more structure in the junior analyst process. So I think there's a rethink coming on how junior analysts are deployed in the investment process. If as a PM, I can update all of my cash balance sheets and cash flow statements, that creates more capacity for a junior analyst to go do more value-added things. But it's less on the junior analyst to figure those out, in my opinion, and more on me to deploy that resource effectively, in my opinion. That won't be everyone's experience, but experience. Routine. Hello, Routine. Nice to see you. Analyst Academy graduate. Not sick of me yet. In your future state example of Skill.md translating qual to quant, what aspects do you perceive the LMs need to evolve to make this a reality? I don't know. Part of the reason I'm excited to start this podcast, just like ask people this question who are smarter than me. Um, I think some of it is the engineer, like the harness, agent harness, um, building sub agents, some of these like architectural workarounds. There's a lot of things, even when we did our version 1.0 of Analyst Academy, AI Academy in fall, we're like, ooh, these things are going to take years to figure out. And it's like they took months to figure out. So I'm kind of like, my prior now is like these things get figured out. Um, I'm trying to be a little bit more, optimistic than pessimistic. Um, pessimistic, but yeah, really the real answer is I'm just gonna like go with the flow and check these things from time to time and follow people on Twitter who are doing YouTube who are doing similar experiments and just get the flow from the community. Like I get a lot of DMs of people, showing me things at work and then I'll check them out. It's like, damn, thanks for the tip. So that's how I'm trying to stay current on all of this and then hopefully share it with you as well too. Have you used the enterprise version of Claude that some financial institutions have used? Heard through the grapevine it can produce a proper three-statement model that's useful for the buy side, at least for the PE side, but have never used it. I have the max version of Claude, which I don't think was different than financial institutions, but yeah, if you hear, so I have not heard that, Alex, but if you hear something different, that would be, I'd be curious. I hadn't heard that. Uh, Trying to understand the value proposition of your new course modeling academy. How would it help students who have attended your analyst academy and AI academy? Analyst academy, we have a 3-hour module on modeling. I think the modeling academy is closer to 20 hours with kind of 12 hours of just a much more detailed decomposition of the modeling process. So if that's your thing. Um, but then really like an 8-hour, much more in-depth model chunking. Really the output of that modeling academy um, isn't necessarily to teach you to build models from scratch, but to have all the grounding so you can accelerate your modeling process with AI. Again, I don't know exactly the timing on that because I think there is some improvement curve that's needed in intelligence to really. I don't want to do a course that's just science fiction. I want to have something that I want to have something that can be done. Antonio Furtado, do you have a PM course coming out? Yeah, I think we're thinking about that in the fall. Um, so stay tuned on that. In all of the courses, I think we're thinking about the 3 or 4 pillars where it's like these are the core ways to do it, and these are the AI elements to do it. So there's, I think, as many like fascinating agentic use cases that exist on the analyst side. I think there'll be even more interesting things on the risk and PM side. Certainly for like orchestrating team research and building a coherent operating system as a PM. I think it'll make the PM job more effective, interesting in a way. Anonymous, are you sure you should not start running client capital again, given your insights as training others your highest and best use case? Thanks for the question, anonymous, anonymous attendee. I quite enjoy what I'm doing now. I am. I do think that I get the bug from time to time, and I think I think there. I don't know if I would go back to like the typical pod PM approach, but as like an AI director of research, to sort of bring in some of these use cases to help firms actually deploy capital. Starting to think about that, doing that on a contract basis. But I think that's where you'll see where we'll see where the world goes um, in um, in 5 years. I'd say what I learned um, attempting to launch a hedge fund in 2018 is that by far the hardest part is raising the capital. Um, so that's that. I also quite like my life as flag football coach and basketball coach and trying to be present with the kids. Although they are getting older and they seem to need me less, which is sad, but frees up more time. But right now, it's AI thing. It's just like pretty fascinating. Do you see the point in the future where stock calls P&L is benchmarked against AI decisions and alpha over AI? so to speak. This assumes we get to a form of AGI. I love that. I love that idea, actually. I was talking to someone today about um, building trading signals in with an AI system. So I'm doing a webinar tomorrow for Wall Street Prep where I took all of 172 of Warren Buffett's selling decisions and put that into a skills architecture and created a would Warren sell agent. Um, and I think you can do that certainly if you have all the internal data at your fund. One of the first things I would do, there's all sorts of like I go down the quant rabbit hole. We talked about this in our Factor Academy. Like your pattern recognition is much more powerful in losers and winners in stocks, right? Fundamental intermediate duration quant is very powerful on the down, powerful on the downside and the upside. Why is that? Stocks tend to fail for more common reasons. They tend to win for more idiosyncratic reasons. It's just sort of the nature of enterprise. What that means is that you see this common thumbprint of losers over time. I certainly see that in my career. There's like 5 or 6 mistakes I just sort of made over and over in my career. So that's great news, actually, because I can start to turn that into codified structures. If you have 20 years of history, trading history, you can go in and study your trading history. You can study your big losers. You could put your big losers into patterns. You can put those patterns into an agent. You can have that agent run risk analyses on your portfolio, and you can not make those same mistakes twice. I think an interesting, sort of framework or benchmark to then use that or build conviction in that is to track how those signals perform. The same way that Steve Mandel used to at Lone Pine, I don't know if they still do this, is they would track saved P&L after they sold the name. So if they sold the name at 80 and it went to 40, right? Often you sort of forget about that, but they would track that and celebrate that and show the P&L saved. And so I think some of that incentive restructuring in businesses is really interesting. Alex, hedge fund recruiting market skews slow right now. I'm not sure if it's war volatility. Yeah, I think P&L hasn't been great. That certainly like during tariffs, that tends to sort of press it. How do you think is attributable to AI getting much better, single manager in particular? Yeah, I think multis aren't really. I don't think. I don't think you're going to see like you're not going to come in and see a big multi-manager cut headcount by 20% this year for sure. Again, like these agents can't do anything an analyst does. And I think like Jevons paradox will most likely hold in these investment use cases. I tend to view like institutional hedge fund seats as secure for at least the next 3 years, maybe even growing. Um, I think the roles will shift a little bit, the same way that hedge funds brought in data scientists to sort of work on all data. I think you'll see more of that sort of data science AI role. Even maybe see sort of incremental growth. Um, I think the near-term play is not headcount reduction, but it's alpha capture. Um, so building these systems to actually drive better out. Certainly on the junior side. Um, you know, Ask me again in 18 months or 36 months, and I may sort of be pressing the alarm button on labor. But I think the recruiting market and headcount market is going to be fine if I had to guess. If I had to guess, it's a little bit different on the emerging manager side because I could run $100 million hedge fund by myself now, generalist small cap hedge fund. Like I don't think there'd be any problem running that by myself now. Simple models, et cetera, or Canalist models, et cetera. So I think some of my friends that run smaller funds don't need to hire as much. But that being said, like one of my friends who runs a small fund paused on the junior analyst hiring, and now he wants to hire an AI analyst. And so maybe one bucket moves to the next. How do you identify when a skill should be subdivided into to limit context rot? It's a good question. I'm trying to figure that out. I'm working with a friend to think about that, like the actual engineering structure of the skills a little bit. Right now, I'm kind of just like it's experimentation to see what works or not. All right, I think that was all the questions I had in the box. Let me see. Do I have anything else? Any hands raised? Um, What does the skill set and background at a small shop look like compared to traditional? It really depends, really depends. You have small shops of an AI analyst. Yeah, small funds are generally going to be, a junior analyst is going to do a lot of things, where you'd have a more defined role at a larger fund. All right. Well, we just did about a 2 hour poke, so I think that's a good stopping point. Thank you for the time. I almost guarantee the next session will be shorter. I hope it's short. I said that every time. Um, I said that every time. We will close up this free webinar series next Wednesday or next Thursday, and then I'll walk you through a few things. Not that we will continue to try and share a lot of this publicly, but we also are a for-profit business. We will, we have a team, and we'll be running programs around this. Um, so if there's interest, no hard sell at all. If there's interest, I'll sort of walk you through some of those opportunities next week. And certainly, if you're at a fund that wants some help on this, we're really launching into mid-May the in-person foundation seminars and some of the workflow labs and helping firms think through this. I find that very intellectually interesting. So that's how I want to spend a lot of my time over the next 18 months. Last one from Anonymous. Are you backtesting skills yet? No. I want to get to the point where I can have that automated ingest variance output. And then I probably will actually run like an automated book. An automated book, but I need to get the process sort of dialed in before they do that. Was this one answered? How much can AI replace the reading stack, 10K, 10Q earnings for analysts initiating coverage on a business or trying to establish a position or to find ideas for investment? This has been a common use case. Hey, I'm looking at a new business. Don't read the K, Q earnings. Like just press a button, get a primer. That's depending on your context. I think that's a dangerous use case. Um, yes, it can accelerate a little bit, but you need to be really careful not to move into the mode of speed reading, right? Um, AI can do your thinking for you. Andre Kapathi retweeted this quote: AI can do your thinking for you, but it can't do your understanding for you. So you really are driving towards understanding. At the end of an up to speed process, it's effective. You effectively have an open, closed book test on how deeply you understand the business. How deeply do I understand Great Gatsby if I sped read it or read the Cliff Notes? How deeply do I understand the business if I read an AI generated primer, right? Um, so I'd say be very careful about bypassing comprehension. Um, there's no rule that you have just because you have an AI system that you have to speed read through the K's and Q's and transcripts. So I think just be thoughtful about that process. Um, that means different things for different people. And Mark, hello, Mark, Analyst Academy grad as well. Seems AI is more helpful on the process front rather than the judgment front. How are you thinking about making sure the process leads to good judgment and not get lost in the process with AI builds and usage? It's a very common approach. Like AI doesn't have judgment. I actually like more and more disagree with that because what is judgment? Judgment is informed by all of these sort of outputs of your investment process. So I think more consideration is better. And so building a wider, more detailed research funnel should drive judgment. Judgment comes out of that sort of detailed, comprehensive process. I think the one thing that's obvious is AI is helpful in process. It's helpful in enforcing process discipline. I remember one time I walked through an analyst academy with a student. I walked through like, hey, you could do this for 60 hours, another 60 hours. And he's like, Brett, like, this sounds great. You just gave me a roadmap to spend 200 hours on a company. And you also said 3,000 in a year. So like, I can do this like 15 times in a year. That's it. And like, that's a really good point. Um, so I'd say, like, having been in a seat where I could spend 500 hours on one name, like, there is that degree of rigor that you can apply to this process. The ability is like, okay, like, I can spend 60 hours, then I can do the next 100 hours with an AI augmented approach, and I can scale that across I can scale that across names now. So by the time I'm making a decision on a name, I pulled up all of the key things management has said and all, customer comments from, a web scrape of different discussion boards on products, et cetera. I'm just making judgment with much better raw input, raw process output. And I can also take the patterns of my past trading, et cetera, into that judgment engine. Hey, flashing red light, like you've been right, only 45% on this side of, type of trade. Flashing yellow light, this type of trade, like you've been consistently 6 months too early. Like maybe you want to size it smaller, wait for 3 months before you lean in, et cetera. And so I think that AI can really facilitate, like AI is a stateless sort of being, doesn't fundamentally have judgment. And investing context, it, if anything, has bad judgment natively, sort of the opposite of what you would want. It can speed you to a consensus view. But I think used correctly, adapted to your process, I think has an immense ability to facilitate better judgment and drive quality decisions. So that's what's interesting. So hello, Mark. Thanks for the question. Maybe that's a great place to stop now as well. So thanks everyone for the time today, and I will see everyone next Wednesday if you're interested. Thank you.